Randy Elvis Frisky and his Las Vegas show band 40th Anniversary Aloha Tour this January in Chilliwack, Surrey, Sydney, Campbell River, Nanaimo, and Courtney. On sale now. Details at randyelvisfrisky.com.
Welcome to This Week in Money, the source for market opinions, brought to you by AmericanManganeseInc.com. Here is Phil Mackesy.
Victor Adair is a 40-year market veteran. He is Senior Vice President and Derivatives Portfolio Manager at PI Financial. You can catch him online at victoradair.com. He's also a regular guest and frequent host on Michael Campbell's Money Talks. Victor is hosting the show next Saturday, December 29th, 8:30 a.m. on CKNW AM 980 in Vancouver. You can listen at cknw.com. And for our friends in the Okanagan, Sunday, December 30th, the next day at 3 p.m. here on AM 1150 in Kelowna. You can listen live at am1150.ca. It's going to be worth it. Victor, it is great to have you on This Week in Money.
Good to be back. Thank you.
It's that kind of a day where you just scratch your head. You survived dental work and the Mayan apocalypse on the same day, huh?
Yeah, I did have an emergency to run down to the dentist, and I forgot all about the apocalypse.
Well, we're glad you did, and the only thing worse than the apocalypse, the fiscal cliff. Still with us, financial stocks falling sharply today after the Republicans canceled their Plan B. Looks like President Obama has outmaneuvered John Boehner, and we assume it's bad news if the U.S. goes over the fiscal cliff. What happens, Victor, if Washington actually gets its act together here?
If they don't go over the fiscal cliff? Is that what you mean by Washington getting its act together, or was that more of a philosophical question?
Well, in this limited situation, Washington getting its act together.
Well, I'll tell you what happened here, Vancouver time, Thursday evening, when it failed at the House of Representatives level. In the overnight trading that we do, the electronic trading, the S&P 500 futures contract fell the equivalent of 500 Dow points.
Wow.
Now, it bounced back to being down only, let's call it 150 or so. But I think, the market was kind of expecting that maybe, Plan B would get approved in the House of Representatives. But when that didn't happen, now that break was in very, very thin markets, but I thought that was symptomatic of how the market feels. And personally, it's been a bit frustrating. If I ask myself, what are we trading? I'm trying to trade in the derivative markets that I trade in, currencies, interest rates, equity indices, that sort of thing, certainly in the metals. And it seems like these days, if you need to be like a political scientist or something to be able to trade the markets. Like we're living and dying on what, good or bad, comes out of Washington. And, I just hate that so much. Yeah. I just went skiing for a couple of days and just turned my back on the market.
Now, you've been doing this for a long time. Has there ever been a time in the past when we have been so dependent on good or bad news out of Washington to run the markets?
Probably, and at the moment, I can't remember it. It seems like we're so obsessed with that sort of thing now. But I was having actually a real good conversation, not on air, with my good friend Mike Campbell just yesterday, and I was saying to him, if you think about it, there's always something going on in the markets that's kind of distracting from what you think, should be the main thing that the markets are focused on. I mean, these days, have pity on some poor guy, with a green eye shade, and he's got his calculator and he's working through his way through a balance sheet or something, and he thinks he finds a good company. He goes out and buys it, and these guys in Washington do what they do, and just totally negate all of the research work that he did. So there's always something going on, but it seems lately we're just overly fixated on what may or may not be coming out of Washington, what may or may not be coming out of the different central banks around the world. It seems like good old-fashioned supply and demand on the commodity side anyway is second fiddle at best to all this other stuff.
One of the things we're working against this week, of course, is Christmas volumes. They are very low, and we've been having a whole lot of fun with Bob Hoy and other folks this month, Victor, about the Santa Claus rally.
Oh, well, did Bobby say he saw it? I must have missed it. We do get incredibly thin volumes, particularly in the currency markets. We get really choppy price action there. But I suppose if we go back to the middle of November the 16th, actually, Mr. Boehner said something at that time that gave the market a bit of a lift. And on balance, We've had a rally since the middle of November. The market thinking, I think, predisposed to think that good things were coming from Washington, good things would come from the central banks. So perhaps that was the Santa Claus rally.
I saw this quote a while ago, and I wonder if it would hold true for next year. If Santa Claus should fail to call, bears may come to Broad and Wall.
Oh, well, that's good.
Yeah.
That's poetry.
That's good, and that's an opportunity for us, right?
You know, here's what I trade, Phil, is what I call market psychology. And I have my own ways of measuring that, and basically I'll look at how a number of markets are trading relative to one another. That's markets in different asset classes, and I'll find sometimes that all of the markets will turn one way or another at a certain date, and I'll call that a key turn date. This psychology seems to me to trump anything else in the market. I mean, if the psychology is risk on, to use that cliched term, then you're better off being a buyer in risky assets. We'll call that stocks, metals, commodities, that sort of thing, and at a seller of the markets like the Treasury bonds, and vice versa if it's the other way around. So lately, since November the 16th, it's been a bit risk on, but it seems to me we're getting some danger signals here that maybe we'll switch back to a risk off market.
Speaking of danger signals, here's an interesting stat from last week. The sell to buy ratio, almost 7-1. Insiders selling nearly 7 shares of companies for each one bought. Is that something worth thinking about?
I think in my experience, insiders are almost always net sellers. So I guess the ratio. I guess if they get really aggressive compared to what they typically are, then that's something worth paying attention to. Listen, we all have our predispositions, and I know I have to watch that when I'm a trader, so that, and one of the things, one of the little signs on my machine says, trade what the market is doing, not what you think it should be doing. That's just to remind me to be careful about that. I do have a predisposition right here to think this market's got a little ahead of itself, so I might be looking a little harder for signs that we could be under pressure as we go into the early part of next year.
Victor Adair, our guest here on This Week in Money. One of the big things shaking the market this week, a deal. The Intercontinental Exchange out of Atlanta buying the New York Stock Exchange in an $8 billion deal. That'll create one of the largest exchange groups in the world. And over at Minionville.com, and they're kind of gloomy. They're calling it the death of equities.
Huh. Well, we remember the famous death of equity cover right before the greatest bull market in stocks ever started. That was a Business Week back in the early 80s. I think the ICE exchange, as we call it, it's like come out of nowhere and been gangbusters. I kind of always thought that ICE was a commodities exchange, and some of the editorials I've seen today address that, thinking that ICE was actually in the process of buying the New York Stock Exchange, but what they were really after was the derivatives business that comes in that package over in Europe. I suspect that may be really what they're after.
Now, you've got some experience in the derivatives business. What does that mean for us?
What does it mean for
traders?
Well, one of my first thoughts was if we get to the point where there's only one exchange left in the world, they can put their prices wherever they want them, and that's tough. I think what we are seeing is a couple of things. There's lots and lots of cost increases all over the business, a lot of them tied to increases in compliance. There's real competitive pressures. I guess what those two things will produce is we'll see consolidation, not only in the brokerage business, but in the exchanges where things are traded.
Interesting quote here, Victor, from MarketWatch.com. The business of running a stock trading marketplace becomes a sideline to the only profit center left, listings.
Well, the whole brokerage industry is really under pressure, as is the insurance industry for much the same reason. There's not any interest paid on the assets you're sitting on. And in the brokerage business, in days gone by, when you had much higher interest rates, the amount of money you earned on the idle cash balances from your clients might have been as much, if not more, than the commissions you earned from the business you did with them. So these businesses are under pressure as market changes everywhere, right? prices of things change. Something that looked like a shoe-in, the favorite son last week is now a dog because of changing circumstances, and that's what's exciting about markets. You're always trying to anticipate changes that are coming and what that'll do to prices and how you can benefit from that.
Not seeing a lot of predictions for next year, and I guess that's because of the choppy trading environment we find ourselves in. Here's one from Dave Rosenberg, who says next year he figures stocks are going to be flat and we should focus on defensive stocks.
I read David Rosenberg as often as I can. I think he's just one of the most thoughtful guys around. He writes an enormous, every day, he writes a letter. He's maybe, from some folks' point of view, he's a little predisposed to be too bearish. So maybe that's why I like him. But, his main thing has been sort of safety and income at a reasonable price, I think is his acronym, for the past couple of years. And hard to argue with that for your savings. And Phil, I may have mentioned this on your show before. I divide my financial world into my trading accounts, where I'm, very active trading the derivative stuff, and my savings accounts. And those are two different kinds of money, I think. One's short-term, one's longer-term. And with my short-term savings account, I can dance in and out of the markets with no problems. With my long-term savings, I've been extremely cautious. And what that means is lots of cash and pretty defensive in whatever I do, thinking, that at some point in the future, asset prices may get knocked down to, let's call it fire sale prices, and I can put some of those long-term savings to work. But until I see that, I'm going to remain very cautious, like David Rosenberg talks about, with my long-term savings money, and I'll be active with my short-term money.
One of the things we'll be looking at next year, of course, will be gold. We've been watching it all year. It is up 5% year to date, failing to take out last year's high, despite all the stuff that went on this year. Well, where do we go from here with gold?
With my short-term trading accounts, I've been net short trading gold. I think the gold market has been disappointing in how it's responded to some things that were, call it bullish news. And whatever market I'm trading, if it's crude oil or soybeans or bonds, and that market does not respond well to bullish news, that's a real flag for me. And I understand, believe me, all of the bullish arguments for why paper money is worthless and you ought to have gold and so on. But clearly, there has been a motivated seller in the precious metal markets here the past, certainly the past couple of months, and more recently, it seems with more motivated selling. It could just be, Phil, that somebody out there, a hedge fund, has had a big position in Apple shares, say, and they're getting their clock cleaned there as those share prices are down about $200 from their highs. Maybe they got huge margin calls, and they're just looking around, in their inventory. Is there something we can sell to meet these calls? And they're selling gold. You just never know what's motivating that seller, but clearly there's been selling, and the market looks like it's more willing to go down than to go up right now.
Victor Adair is Senior Vice President and Derivatives Portfolio Manager at PI Financial. He's online at victoradair.com. Don't forget, Victor hosting Michael Campbell's Money Talks next Saturday, December 29th, 8:30 on CKNW AM 980 in Vancouver. You can listen live at cknw.com. And don't forget, Sunday, December 30th, 3 p.m. here on AM 1150 in Kelowna. You can listen live at am1150.ca. Hey, Victor, thanks, and hope you have a Merry Christmas and a Happy New Year.
Thank you kindly, Phil. You too.
This Week in Money is archived online at talkdigitalnetwork.com.
Tim Wood publishes Cycles, News, and Views. Tim covers the stock market, gold, oil and gas, treasuries, and the U.S. dollar. The December issue of Cycles, News, and Views is out. If you'd like more on Tim's work with Dow Theory and the Cycle Turn Indicator, visit cyclesman.net. That's cyclesman.net. How are you doing, Tim?
I'm good, Phil. How are you?
We're just watching the financial news this morning. The Dow up over 100 points, the S&P at a 2-month high. Wall Street obviously encouraged about the fiscal cliff talks going on. Oh, now, you and I and a lot of folks have been having fun with this Santa Claus rally all month long over at minionville.com today. Here comes the Santa Claus rally. And on the other hand, over at Forbes.com, Santa Claus rally stalled as fiscal cliff looms. Now, a lot of conflicting opinions out there, and there does not seem to be a whole lot of logic, and that's kind of the way we prefer it, right, Tim, as investors?
That's the way I prefer it as a technician. I listen to absolutely no CNBC, no Bloomberg, excuse me. I just don't pay attention to the news and the fundamentals because, quite frankly, I don't think they matter as a technician because everything is discounted into price. Everything is in price.
Now, something you and I have been talking about for a while, it can be frustrating at times that folks are not hearing all of your message. We basically hear what we want to hear.
That is true. And I'd like to talk about that and the herding mentality, a couple of things. And this I guess it kind of ties into the technical perspective that it's all in price. And there's a couple of pitfalls. I've seen this over and over and over, Phil. As we moved into the 2000 top, I mean, the bullishness, I remember you could cut it with a knife. Mm-hmm. And I made the call based on statistics, based on something that happened. I mean, it's in print. This is not a stop clock thing. I am not a perpetual bear. I think you remember, let me just preface this, back in 2011 when everybody thought the market was falling apart. I don't know of another, and I'm not patting myself on the back. I'm trying to make a point that because of these same statistics, I made the call back then. I think you and I talked about it. I think we talked about it on the air and made it public. That no, the market's not falling apart. It should move above the May 2011 high. And so I want to say all this to say this up front. To call me a perpetual bear is, I think, is just wrong.
Yeah.
Because when everybody was bearish there, I made the bullish call. And so I have to preface this whole interview with that. And the other thing, and people hearing what they want to hear, I had someone send me an email, and they said, Tim, you talk about, the caution of this rally and how this rally is, you've been saying that it's a counter trend rally within the context of, no, well, he didn't say that. He just said that you've been cautioning about the rally. You've been cautioning about the rally. You've been cautioning about the rally. And this guy's been short. And he's not reading the newsletter. He's just been short. And, I read that and I'm like, the frustrating thing to me is that, like you said, people don't hear the entire message.
Yeah.
What I have said, and I think I've said it in every article, I've certainly said it in every newsletter, and I think I've made it clear in our interviews, is that, yes, when we back up and look at this from a long-term perspective, looking at the Dow theory phasing, looking at the values, looking at all the stuff that, historical markers of a bear market, bull and bear market relationships. We've done articles on that that's posted on the site. We've talked about it. Maybe we need to do another interview on that and discuss it. But by any historical measure, 2009 was not a bear market bottom. So this is a rally. Yes, it is a rally within the context of a longer-term bear market. No question about that, according to that data, according to the statistics. So I have to go with that. Now, that said, I have also said that this rally would continue until the DNA markers are in place. In the by DNA markers, there's a set of specific indications, specific thumbprints, a set of common denominators, whatever label you want to put on it, that have occurred, that I have identified through my research, that has occurred at every major top since 1896. It is also, we've also seen that DNA marker, or those DNA markers, at 20 of the last 28 four-year cycles.
Wow.
Going back to 1896.
Okay.
And so my story hasn't changed. Yes, this is a bear market rally within the context of a longer-term secular bear market, no doubt. And the rally will continue until those markers are in place. Now, that said, I want to go back to 2000.
Let's do that, because that was the peak of the dot-com era. Markets looked like they were just going to keep going, and there were bulls everywhere. What happened? What were you talking about then, and what happened?
Well, that was what got me into the newsletter business. I wrote an article I just did some research, and I gave it to my broker friend. He looked at it and said, oh, my God. He said, this is great. He said, you need to send this to a magazine. And I'm like, okay, I'll try it. That's a good idea. What the heck? I had nothing to lose. So I sent this to Technical Analysis of Stocks and Commodities magazine in early 2001. Market still near its highs. It topped in January 2000. You go back and look at a chart. It just kind of flatlined in there throughout most of 2000 and early 2001. And the article came out, and it called for, based on statistics, it said that because of the setup, the DNA markers, if you will, that were in place, that the 4-year cycle decline into 2002 would take the market below the 1998 low. I got emails from people telling me I was stupid, telling me, making crackpot jokes and all kinds of stuff. Well, it didn't matter to me. I didn't care what they thought.
Mm-hmm.
I had no dog in the hunt. It's just research. I'm basing my opinion on the research. Well, it happened. It happened exactly as the statistics said.
Wow.
Well, all of a sudden, then people come to me and they say, hey, you're not so stupid after all. We want a newsletter. And I'm like, well, I don't know. And so finally I started a letter. People saw the value in this, and that's how the letter, come to be.
Okay.
As the market rallied into 2005, 6, and 7, as we moved into there was a mild decline in, I think it was June, July of 2006, and everybody and their dog that could count, we had a 4-year cycle low in 2002,
Mm-hmm.
so 2 plus 4 is 6, and so everybody wanted to come out and say, because that article in 2000 got so much attention with the 4-year cycle, everybody was all of a sudden a cycles expert, and they said, oh, the low in 2006 was a 4-year cycle. And said, no, it wasn't. We didn't see any of the DNA markers in place at the little high there before we, prior to, I think it was May or so of 2006. And we didn't see any of the DNA markers at the low that was either in June or July. That was not a 4-year cycle low. It made the call based on statistics. I said, no, what's happening is we're seeing a constant erosion of the internals. We're seeing an erosion. That it is a longer, drawn-out setup, and the cycle is extending. And that is exactly what happened. I also said that when it pops, it's going to be worse because of the efforts to keep the market afloat, that the backlash would be a much more pronounced, more devastating decline. And that is exactly what happened. The DNA markers finally did appear at the top in 2007. It's in print to my subscribers. It happened with those DNA markers, and the call was made using statistics. The same thing happened with the top in crude oil. I think you and I talked about that back in 2008. The commodity call as a whole. Housing prior to that in 2005 made the call using these statistics. And so the point is that I'm not trying to pat myself on the back.
No.
Still. I don't want people to get the wrong message here. The point is I am again shouting from the rooftop that the herd is looking at this rally. Well, let me back up. What I said would happen, I told my subscribers as we moved into the low in 2009, knew the low was due based on the cycles work, based on the statistics. And I told them, I said, this is a low of a higher degree. And the longer the rally lasts, the more dangerous it will become because more and more people will buy into it. They'll be forced to buy into it. It will become more convincing. And I remember at the low in 2009, every analyst on the planet was bearish. The rally out of that low was a counter-trend move. Everybody was on the same page. I was on that page based on statistics. I think they were on that page based on I don't know what. Well, now, find me a bearish newsletter writer besides Bob Prechter.
There's nobody.
Find me someone. Everybody has and why have they done that? Because exactly what I said.
Yeah.
Based on the based on the duration of this rally and the linear thinking, people have now, to think that this is a counter-trend rally within a secular bear market, you've got to be nuts to think that. And so even the most bearish of the analysts back in 2009 and 10 have capitulated. And I think that's because, like I said, of the rally, and two, it's a much easier sell to sell people what they can see.
Yeah.
Rather than what they can't see. So if I was to get on here and tell everybody when gold's going up, hey, gold's going to $2,000 an ounce, and when oil is going up, say, hey, oil is going to $200 a barrel, and when the stock market is going up, say, hey, the stock market's going to this. That's an easy sell because you can see that.
But nobody ever calls the top, and that's one of the things you're pointing out in the herd.
They don't. With the herd misses it. And what I'm saying is it the same that these statistical markers worked in 2007, at the low in 2009, with the top in commodities in 2008, with the top in housing, and with the top in 2007, it will work with this top that's pending. And the point I'm trying to make is that the herd can't see it, and the herd never sees it. And, it's a matter of statistics. And I stick to my guns based on the data. This is a counter-trend rally within a secular bear market, and I don't know if the DNA marker is going to appear next week, next month, next year, or today. But when I see it, I'll see it. And when I see it, there is nothing the Fed or anybody else can do. It will unfold. And so that's what we are constantly monitoring, is to the appearance of those markers. And when they happen, it's done.
Yeah.
But until then, the rest of the message that is so vital that people don't hear is they hear this and they say, oh, well, he's bearish because he's saying this is a counter-trend rally. Yes, that is right. But the other half of the message is I'm bullish until they appear. It is a counter-trend rally that will remain in force until we get those markers.
You're just basically working off the research, right?
Right.
Yeah.
It's based on the research. And so the source of my frustration, if I sound frustrated, is that I am trying to get people to hear the entire message and to understand that this isn't some kind of, taboo thing. Mm-hmm. There's a train wreck out there. It's coming. It's coming, and we have a market analysis is not scientific, but when you break it down and with cycle quantifications, and you go back and you look at do the data mining with these the DNA markers, and you get some percentages, and you say, 80% of the time this has happened, this has been the outcome, or 100% of the time this has happened, this has been the outcome, or 90, or whatever the percentages are, then you are approaching the market with an emotionalist, more scientific approach, and that's what we do, and that's what we're looking for. And that's why, I've been able to make the calls I've made. And the herd is not hearing the message. That's the danger.
Tim Wood, our guest on Cycles News and Views. Tim Wood from Cycles News and Views, our guest here on This Week in Money. Tim, for our podcast and radio friends who are thinking about the gift of market research, tell us how we can benefit from a subscription.
Phil, the research is available through, I call it a research letter, not a newsletter, because it's much more than a newsletter. And so the more in-depth research is available there. And then I do updates 3 nights a week. That comes along with the research letter, and it's available through a subscription at Cycles News and Views. If
only your friend with $1 million had thought about that, right?
Right, but the thing is it's just like it goes back to that, and like whenever the 2008 top, and we saw the decline in commodities and the decline in gold and all that. I may have told you the story before. I mean, I literally have had grown men, this happened on 2 different occasions, call me crying. I'm talking crying. They lost so much money in gold and said, what should I do now? I'm like, well, I don't know. I mean, it's why didn't you listen to the research? I mean, the research is what it is. It's like going to the doctor and getting a blood test, and he says, well, the blood test says this. Well, to argue with that data is just, I don't know what to say.
It's going to come back and hurt you.
Yeah. So my point is that, even if I could give this newsletter away on the street corner, and if a person doesn't have the eyes to see and the ears to hear, in other words, if they don't have the open mind to look at the research and accept it for what it is and go, you know what, this stuff makes sense and it's based on these, and if they can't see the value of the research, they're not going to hear the message anyway. The guy with gold, he had the letter, it didn't matter. The guy that lost $1 million, it doesn't matter. People are going to hear what they want to hear, and that's the message I'm trying to give them today is don't have preconceived notions. There are some statistical approaches to the market to guide us.
You need them now more than ever, right, Tim?
In my opinion, that is correct.
Tim Wood from Cycles News and Views. The December issue of Cycles News and Views is out. Now, if you want to subscribe and get the benefit of Tim's analysis, focusing on what we've been talking about here, visit cyclesman.net, cyclesman.net. And if you want to get in touch with Tim, that's also easy. It's Tim at cyclesman.net. Tim, it's been a great year. Thank you so much for all the time you've spent with us, and I hope you have a Merry Christmas and a Happy New Year, my friend.
Phil, same to you, same to our listeners, and thank you so much for having me.
This Week in Money is archived online at talkdigitalnetwork.com.
Richard Knowles from Knowles & Associates in Vancouver is here. He is a personal and corporate financial planner, and you'll find him online at customplanfinancial.com. Rich, Merry Christmas, Happy Holidays. Good we survived the apocalypse, and welcome to This Week in Money.
Yeah, thank you, and the best to you and your listeners as well.
Rich, for our radio and podcast friends who have not met you yet, tell us what you do and how that can help us.
Well, what I'm currently doing for the last 20 years has been being a financial planner, a financial advisor, so an investment advisor, as also a risk management expert in the areas of insurance planning, corporate group benefits, and personal corporate tax planning as well.
One of the things I mentioned to you off the air was that we do not seem to have very much financial planning advice here. We're always talking about gold and stocks and bonds and the Fed and what's going on economically, but it's always good to step back for a second and try to put that into some kind of context. So let's talk about what our financial priorities for the next little while ought to be.
Sure. At this point, we're looking at an interesting situation coming up in the new year. When we're looking at the U.S., we've been really quite led by, of course, the United States and what they do, and a lot of their financial woes flow over into Canada. So what we've been looking at is the fiscal cliff, and you've probably been hearing a lot about that, Phil.
Mm-hmm.
So the fiscal cliff has been a bit of an issue because we're not really sure where they're going from the perspective of their next cycle. Now, their next cycle is facing two options. If the fiscal cliff goes through, in other words, if nothing gets done by the Republican House, then we're going to be facing tax hikes, various savings issues, things that they're going to have to do, let people go, fire people in the government, et cetera, et cetera. There's a list of things they're going to do. To do that would mean that they're likely, at least it's speculated by a number of economists, that we're likely going to go into another recession in the U.S. Now, that doesn't spell well for us here in Canada. We need them as a partner. We need them as a trading partner. They certainly buy our products. And therefore, for them to go into a recession doesn't help us much. So if that were to go through, and it's at this point quite likely to go through, we'll be faced with a bit of an initial market correction, although it won't be that deep because at this point, the stock markets have factored in the fiscal cliff to a certain degree. There will be likely a sell-off in any case. There's always a fear sell-off at some point. And there would be an opportunity for many of your investors to look at an opportunity to buy. Now, that's the big signal here. It's not... It's to be out of the market when it happens and to get ready for a purchase after it does. Mm-hmm. If it doesn't happen and things are stable, then that's fine too. At least we know and we can at least forecast where we're going. So the worst thing that we're looking at right now is the unknown. When things are known, at least we can act on them. So that's what we're looking at now. So the fiscal cliff is the big issue in the markets today. But if we have a plan, we can act on it.
It seems like even with what's going on, this fiscal cliff seems to have everybody spooked. Here's an amazing stat. After a 13% gain in the S&P this year, U.S. stock funds have seen $110 billion in net outflows. Why the disconnect?
Well, this is, again, the big fear issue is when you've got fear overhanging a market, you see these disparate issues occurring, or these disparate numbers. You find a gain, and yet people should be acting on that gain. On the one hand, that sounds as though that's what people should do, but think about it. Think about it for a second, Phil. What's the big thing? What's the biggest first lesson you learn in investing? Buy low.
Sell high.
Right. So if we've seen an S&P gain in this year, and we're expecting a market correction because of the fiscal cliff, guess what the smart money is doing right now?
Moving out.
Right. So that's why we've got this disparate or this differential in what we would ultimately expect in a growing market.
So what's going to happen for next year? Here's Dave Rosenberg, Breakfast with Dave, talking about markets, says they're going to be flat. We should focus on what he calls defensive stocks. Doesn't that kind of put us at a disadvantage for next year?
Well, I guess you could read that too. Defensive stocks in defense, or stocks to defend yourself against market corrections. Yeah. In this case, I'm pretty sure he means defensive stocks and defending yourself against market corrections. And this has been a very standard thing we've seen for the last, certainly for the last year, if not a little longer. Certainly I've been saying this, and many people that I do know have been saying this as well, that would be considered pundits in the industry. They've been saying to get paid to wait. So that's the best expression we have today. I really love it. I've been very fond of it. I've been using it a lot. Get paid to wait. Mm-hmm. Why not? If we have to wait out a market correction, if we're concerned about what we're going to be doing in the stocks, then why not at least get paid to wait? So go to fixed income. A lot of people have been doing that. Of course, that's been bringing up the prices in fixed income, and in fact, their yields have been dropping for that reason. So a lot of people are saying today, and some of the best buyers have been saying, don't buy fixed income today because the best deals are, guess where? They're in dividend stocks. Because for the first time in our known history, the dividend of a stock is paying more than the interest from a bond. And so that is a very exciting prospect. Now, your listeners should always be aware of this fact. When you have a dividend being paid from a company, that means that stock or that company has got so much in earnings that it's able to pay a dividend. So that's a very conservative type of company. Okay. A company that's been around a long time typically, has got lots of earnings sitting on their books to pay out a sizable dividend. You can look at the history of the dividends, and that can tell you just how safe and secure that company is. So defensive stocks today are the term we use in the industry, are dividend-paying, large-cap, secure, conservative, what we used to call in the old days grandma stocks, safe, secure, long-term holds that can pay you while you wait as they recover.
I guess what we call those now are blue chip stocks, right?
Blue chips, yeah.
Yeah. These are huge companies like IBM, AT&T, the Royal Bank, et cetera, et cetera.
Exactly. Now, that spooked a lot of people in the last few years, especially after 2008, because what we used to consider the massive blue chips, AIG, Citigroup, all these big banks suddenly failed, and then they nearly crashed, and they had to be bailed out by the governments themselves. Now, that in itself, you could say is a fair reason not to buy them. On the other hand, one of the most reassuring things that occurred was that the governments did, in fact, come in and bail them out. And they are, in fact, standing today paying dividends. So that is a very reassuring thing for all of us to consider when we're buying stocks.
Richard Knowles from Knowles & Associates, our guest here on This Week in Money. We've talked about the big blue chip companies, the safe defensive companies. What about the more aggressive companies, gold mining companies, for example?
Well, gold is certainly looking very attractive again. One of the big reasons gold looks good is particularly because of the fact that we have a money supply issue. When you're looking at the U.S. right now, their plan, and certainly has been since the fall of last year, has been to print money unendingly. So there's no particular plan to stop. It's just keep interest rates low, print as much money as they need. Well, this doesn't spell well for the U.S. dollar. If you keep printing something, of course, just like supply and demand economics will show you, if you print too much of something, that individual thing will go down in value. And that's exactly what we've been seeing, certainly against the Canadian dollar and other currencies. It's not just a made in the USA situation. It's a made in print. It's made in the treasury problem right now. So gold, when the currency is going down, gold and hard metals in general look very, very good. We've seen a correction on gold this last year, towards the end of the year, certainly. And so it hasn't been, it's lost its luster in the short term. But in the long term, I believe that gold, as long as they continue to print currency the way they've been doing, will look very good.
And that won't change in the next year or so? I wouldn't think so, right?
I'm sorry, in which case?
The printing of the money will just continue.
Yeah. I believe it will. It certainly is the number one priority over the next 3 to 5 years, actually, is to keep interest rates very low. I don't see an increase in interest rates for at least 2 years out. There could be something, sure. I can't see anything from the U.S. Canada might threaten to do it, but really we don't have a growing economic environment to increase interest rates. But I can see currency being printed, perhaps put back under control, so they may limit the amount being printed at some point in the future. That's what I would hope they would do, is rein in the horses a little bit. But certainly they're letting the horses run and gallop. Yeah.
All this
gold looks good.
All this money printing got to be good for gold and for silver, and realizing that everybody's different, that not everybody has the same investment objectives. Where, on average, do precious metals fit in your portfolio? What are you telling your clients?
Well, that really is a specific client-to-client question. Various clients, depending on their needs. I have clients that are seniors that need income. Yeah. Gold just would comprise maybe 5 to 10% of that portfolio for the growth element, because we need the majority to go to work. Depends really on your needs. It depends on your age group, what your purpose of the money is, many, many different questions. But certainly I think that if you've got a blended portfolio and you're looking at a balanced approach into everything that you need to do right now, I believe in staying defensive. So I would be looking at gold prices, positioning 5%, 10% at this point, and growing as the year goes by. This is something you have to monitor on a regular basis, and you could add to that position as long as you're comfortable with the potential volatility.
We are talking to Richard Knowles from Knowles & Associates here on This Week in Money. And let's get back for a second to basic financial planning. Some of the things that we ought to think about in 2013, obviously besides managing our debt, be defensive in what we do. Any other ideas that you can bring to the fore for 2013? Stuff we should be thinking about next year?
Well, it depends on the avenue you're coming towards. Right now, we have a type of product that has been extremely popular that is now being phased out slowly. And of course, as soon as you hear that the industry is phasing something out, the purpose of doing that is to save them money, not us. So one of the products that has been extremely exciting and certainly is the best part of it is starting to end this year is a type of guaranteed product. It's an investment product, actually, but it's insured by insurance companies. It started in 2007. And between 2007 and about 2011, it had garnered about $40 billion en masse from Canadian public trying to buy more of this product. All it is effectively is it's like a mutual fund that's been insured. So it's got a principal guarantee on it, but it also has a minimum guarantee of return every year as long as you keep it in the program. And eventually, when you go to take the money out, they'll guarantee a lifetime income even if you run out of money.
Okay.
So it's a very sweet little product for a lot of clients. We've been able to position a lot of money in there before the best deals closed out by the end of this year. 3 or 4 of there's only 7 companies doing it. 4 companies have left the industry. 3 are remaining. There's only 1 plan left that hasn't changed at all since the initial stimulus occurred. They'll be changing their contract into the new year. But I'd look into this for a lot of your clients that are looking for guarantees, protection, want to still take part in the markets but not have to worry about it, especially for their long-term income.
I got to ask a dumb guy question here, Rich. Why is this product disappearing?
Oh, no, that's a great question. The real reason it's disappearing is because it's becoming so expensive for the insurers to protect it. In other words, they can't provide the insurance at the rate they're able to do it. The interest rates are so low now that they can't provide those guaranteed returns. What they are doing, and many of the companies are keeping it, instead of giving a 5% guarantee every year, minimum guarantee, they're giving a 3% minimum guarantee. There's an example of the changes.
Rich, let's look back for just a second on 2012. What's the one thing that you wish that you had done this year that you didn't do?
The one thing that I could have done that I didn't do. This year, I wish I'd sold my personal property at a higher price rather than waiting until now and possibly next year to sell a property. I can't really say. Of course, there's always regrets on certain individual issues that you could have jumped in on. Of course, hindsight's 20/20.
Yeah.
Phil, I don't beat anyone up over it. I certainly don't beat myself over it. And I think if you stay to your traditional values, if you stay, I think that everybody that stays with their traditional values stays with the numbers, makes common sense decisions. And if anything, my only regret is I didn't have what is known as common sense more commonly in my life.
Hey, you and me both. And that's the one thing that you mentioned off the air is that there's an element of science behind all this, and that if you focus on the numbers rather than on emotion, that's going to be a whole lot more helpful for you next year.
I sincerely believe so. I think if you stay with your disciplines, it's all about discipline next year. It's been about discipline. It will be all about discipline. Don't let emotions don't let fear, emotions create the problems in your life. Stay with your discipline, stay with your traditional values, and we won't lose.
Richard Knowles is a personal and corporate financial planner. He's with Knowles & Associates in Vancouver. And Rich, give us a couple of contact addresses where we can reach you, would you?
Sure, it'd be my pleasure. You can contact me via email at richknowles, RICHKNOWLES, @hotmail.com. And you can also access my website at richknowlesfinancial.com, and also our corporate website at customplanfinancial.com.
Richard Knowles, best of the holiday season, and Merry Christmas to you, my friend.
Thank you very much, Phil, and the best to you and your listeners.
Thanks to our guests, Victor Adair, Tim Wood, and Rich Knowles. And thank you for listening. I'm Phil Mackesy for AmericanManganeseInc.com. We're back next week with more This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.